All right, everyone. I'm William Phillips of Phillips Financial Strategies. I am here to speak to you today about recent market volatility that we have had and market volatility that we are going to experience again in the future. Why it matters, why it's nothing to worry about overall the long term, and why you should pay attention to it now. So with that, I'm going to give you guys my sort of three rules of thumb, as it were. So first is know what you own and why you own it. Second is supply and demand, filter out the noise. And then third is where are the opportunities? So first item, know what you own, why you own it. So what that means specifically is what's in your portfolio. If you're one of my clients, we spend time sitting down regularly in our meetings, talking about what's in the portfolio, what the direction is based on financial plans. I know some folks like to manage their own investments. That's perfectly fine. The important part is that you should know what's inside that mutual fund or those indexes, or why you have a particular stock and your money is invested with that particular stock or with that particular bond. That said, know what you own, know why you own it, know what it is. And if you're working with another advisor that's not us, that's okay too. Ask her or him why it is that something exists in your particular portfolio. What purpose does it serve? That's okay to ask. It's your money. Remember that. The other piece, supply, demand, filter out the noise. What's going on? We call them equity markets. We call them trading markets. Markets are places of supply and of demand. And so sometimes we see market movement based on supply, demand, buyers and sellers. That's okay. We see periods of volatility based on the number of buyers and sellers in the market from time to time. That is a simple, normal function. And that may very well be what we are seeing in the markets today. And I'm going to show you guys some graphs that are going to be useful associated with that. In addition, I'm going to show you a couple of slides that are going to be useful for thinking about what your shopping list should be. What are the things that you might want to either add to your portfolio or subtract from your portfolio as you're making decisions for the future. Remember, so we're seeing the present, we're seeing the supply, the demand, we're seeing what's going on in the portfolio, and market conditions, and then we're making decisions. We're not making decisions and then going back and figuring out all of these various other things. So it's not ready, aim, fire. Get the idea? So that said, here's a quick screen share. Let's dive into it. So why be diversified? Well, we want to be diversified because here's a number of areas here's a number of what's called factor performance. And by the way, I got these slides from the JP Morgan Fund's website. This is a guide that they put out quarterly. It is called the Guide to the Markets. I find it to be a particularly useful tool. It's got a lot of economic data in it. It's got a lot of market data, and it's got it all in one place. So I've got 71 slides that I can look through and get a quick understanding of where various equity markets are relative to their history. Again, it allows me to see the present with clarity without a bunch of noise because I can sit quietly and read it. I'm not watching a news program. I'm not doing something else. This gives me good, clean data that I can utilize for decision making. And again, it gives me an idea of the markets. So for example, I can see the markets, buyers, sellers, premium, discount, understanding kind of what's going on. It gives me some basic insight. And like I said, it's 71 pages. So there's a lot of information here. Don't worry, we're not going over all of it today. So I'm not going to bore you with it. I know because some of the material is really dry, like Sahara dry. So that said, I'm going to start with probably the most important slide. We started off the year really well, and then the market started to slide a little bit, and that's okay. That is completely perfectly fine. And I know you're thinking, William, that is not okay at all, but bear with me. So here is a quick slide of the S&P 500. Over the last 42 years, this is what we see. We see these red dots. These represent the market low in any of those given years. These gray bar graphs, these represent where it is that the market finished the year, positive or negative with returns. What we see is that most of the time, those returns are positive. And most of the time, those returns are in the neighborhood of 10% or greater. Go ahead, factor the dots. I'll wait, pause the video, come back after you've generated a statistical model, spreadsheeted it, it's okay. That said, when we look at this, what it tells us is it tells us that throughout the year, most years, the average drop is around 14% from where the market starts the year in the S&P 500. Yet we finish up around 10%. So there's a whole lot that we could get into regarding volatility index and that kind of thing, but that's not the purpose of the call today. The purpose of the call today is to understand what's going on, buyers, sellers, that kind of thing. The reality is that we have gone a long time since we've seen one of these 10% or greater pullbacks. And they happen with regularity. They are a function of supply and demand and of buying and selling, natural movements within the market. And so what we see here and what we should expect in any one given year from when we start the year, between the time we start the year and we finish the year, that the market and various sectors are going to slip, maybe in the neighborhood of 14%. In all likelihood, we're still going to finish the year positive. That's okay. And so that's the thing that you need to realize. And so what does all this mean? Why does it matter? What are we utilizing this information for? Our diversified portfolios, knowing what we own, knowing why we own it. We can see and understand in the investments, are we trending better than or less than where the markets are going? So this gives us an idea. Do we need to make changes? Do we need to make significant changes? What's going on? It allows us to answer those questions in an astute fashion. Now, the bulk of what we've seen here, because remember, it's a function of supply and demand, what drives the markets up and down. The other thing that drives the markets up and down, earnings. How much are we spending as consumers? It is a consumer-driven economy after all. So the numbers look good from the last earnings report, the last quarterly conference calls. We didn't have any major disruptions. We don't have big things on the horizon. Okay, we can talk about inflation all day and where that comes from. That's another call for another time. The reality is that we're trying to talk about what's going on with volatility in 2022 in the first quarter. And so the reality is it's been a long time since we've had one of these drops. We're probably due, and the thing about these drops is that you have an idea of when they might occur, but you don't know when, and you don't know their magnitude. So it could be 3%, could be 20%. You don't know. And you don't know where the market's going to finish the year. So the point is that you stay invested and you're diversified. Okay. And I'm going to get to why that's important in just a quick second and why you're diversified. So now that we understand that, now that we understand the market movements and that we don't have anything really to fear because markets move around. We expect them to go up. We expect them to go down. The long-term overall trend, however, is up. And this is what I'm going to show here in this slide. So if you look at this from 1996 all the way to the present, what we see is a very impressive return of the S&P 500. So even during flat periods, the overall trend line, if you're regularly rebalancing and you're diversified, which means not everything's going up and not everything's going down at the same time, gives you the ability to generate positive returns over the long time period. Okay. And I'm going to show you that now with this next set of slides. So you'll see what I mean. It's about staying the course and being diversified. I'll give you a minute so you can count all of these up. Go ahead and pause the video, count the various asset classes. The thing that I'm going to emphasize to you is to look across the top here. What you're going to see, very simply and very straightforward, is that from year to year, periodically, those assets, the asset classes change. So if you've got a little money in kind of all of the asset classes, you don't have to worry about having the right asset class. What you do have to worry about is staying invested. And the reason I talk about staying invested and the reason why it's important, this gets into filtering out the noise and what you want to buy. So parts 2 and 3 of our conversation is that if you look through all of these, the thing that is not the best performing asset class most of the time is your cash. The thing that does show up as the least performing asset class is your cash over these extended time periods. So that said, be invested, be diversified. So that way you can be somewhere along this line of best fit with the asset allocation. Yes, you won't get the best returns, but you won't get the worst returns either. And here's what that means. Here's what it generates to. What it tells us is that long run 20-year rolling returns, compounding interest, by the way, these are rolling returns from 1950 to 2021. What you see here with each of these various gray, blue, and green is that simply staying invested, regularly rebalancing, choosing your course of action. Maybe you want a little more risk when you're younger. Maybe you want a little less risk when you're older. Maybe you're living off that income. And so you want to skew the portfolio accordingly. But what it tells us is it tells us that if we stay invested, we regularly rebalance, it tells us that we have returns that are generally positive, and more importantly, those returns are generally greater than that of inflation, which means that our investments will grow faster than inflation, which is an important thing. We can't have that happen if we pull money out of the market and we put it in cash, because then we're not invested, we're not compounding. And we see that here with this information. So what do we know? As a quick recap, since we're drawing to a close here, we see the present with clarity. What we see is we see market volatility. What we know is that that happens. It is a function of the marketplace. It should be expected. Next, we talk about, and we know what we own, so we're diversified. We've got all of our bases covered, because not everything is going to move up and not everything is going to move down at the same rate, same time, or at the same moment. Next, we're seeing the present with clarity, with buyers, sellers, supply, demand. What's moving up, what's moving down. Understanding how that functions, and that creates those market cycles of up and down, which give us the opportunity to rebalance. Next, now that we understand what we own, we understand why we own it, and we see the present with clarity, and we filtered out the noise. Now we can make decisions for the future. We can start being forward looking. What are the things that we want to take advantage of now that we know what's going on in the marketplace, now that we have an understanding of both what we're comfortable with and with what's going on within the markets? What do we do? How do we adjust? How are we tactical? Here's a quick slide that I want to show you. This is about just staying invested over the last 20 years with all that volatility and everything that I showed you. Sometimes doing less is more. So if you're managing things on your own, or you're working with a financial professional, if you're not one of our clients, I encourage you, take a look at this slide, make some, and it gives you a good idea of what kinds of actions or steps you need to take. For our clients, you guys have seen this, and gentlemen and ladies, you've seen this slide many times, and we've talked about this a number of times. I've done some state of the firm calls. We've had numerous conversations with it. The reality is that if we just leave things alone and we rebalance accordingly, What this shows us is it shows us that we generate returns. We grow our asset pool, and we take advantage. Sometimes when things are down, we don't like it, but what history shows us, what the information shows us, is that we start taking advantage of those things. Over the long run, we're rewarded for making those moves. And what it shows us is that if we just simply stay invested and we leave things alone, what we do is we outperform historically what has often been the average investor. So those that are just simply not looking at this information, not filtering out the noise. This was a fairly extensive study that's been completed. Here's all of the disclosures right below, so you can see where they collected their data from. The point is not to show you how amazing these returns are. The point is to show you that if you filter out the noise, you see the present with clarity. Even if you simply have a 60-40 well-diversified portfolio like I just showed you, and you regularly rebalance the thing, it does okay even through periods of tumult. So that said, I encourage you, take time, digest this, understand that up and down is a function of the financial markets, and that if you're diversified and you stay invested and you continue to rebalance through the period, that over the long term, you'll do all right, because the overall trend is upward as things grow, as things change. And what it tells us is that you will likely outperform those that try to get into or out of the market based on timing or emotion. So with that, I'm William Phillips for Phillips Financial Strategies here in Washington, D.C. If you have questions, pick up the phone, send us an email, schedule a time. Happy to get together. Happy to go over what's going on in the markets. Happy to answer questions, talk about what's in your portfolio. If you're managing things on your own, hope this was useful for you and was worth the watch. And for those of you working with other advisors, please, I encourage you, don't be shy. Pick up the phone. Either talk to your advisor, her or him should be able to answer these same kinds of questions and give you the same kind of clarity and comfort that we give to our clients. These are important. That's why you utilize professionals. It's why I utilize professionals in my own life. That said, have a wonderful evening. Have a great day, no matter where you are in the world. And we look forward to chatting again.